especially if you go further in business classes, if there's something you might, like, not this chapter, but chapter 10, when we do long-term assets, when we do bonds, we'll come back on that, especially in Finance 1, we'll come back on that concept. So maybe you'll go back onto the video and say, okay, what did he say about bonds? What did he say about premiums and discounts? That makes sense? And it'll help. Utilize the technology that you have. This is very, very helpful. All right. So the next two chapters, I alluded to this, but now I'm going to say this up front. The next two chapters, we're going to deal with our liabilities. Right? Chapter 9, we're going to deal with current liabilities. Chapter 10, we're going to deal with long-term liabilities. All right? I want to make sure that everyone understands this concept. Liabilities are, right, the company's present obligation for a past service or product. So it's the company's present obligation for the past service or product. What happens is that when you borrow money, you are committing a certain portion of your future earnings to pay off your current service or your current product. So you'll receive something today and the promise that a percentage of your future earnings will be paid into it. Now, I'm not as much of a doom and gloomer. The reason I'm drilling this in is because there will probably be another financial crisis. And all financial crises pretty much to me have found its nexus in the American people forgetting that loans are current obligations, right? Or you're receiving services or product today for the promise of dedicating future earnings to the organization that gave it to you. For some reason, we lose sight of that as the populace. Everybody with me? Now, do I think you will see the next financial crisis in the next 10 years? No, not a doom and gloomer. You're probably 20 years old, so you probably see one by the time you're 80. You'll be old. I'll be long gone. So I've only seen one once in my life, so I figured out be it. But just a warning, you probably will see another. Because the first one, you were pretty young, right? 2007, y'all know about what? Your kid. Yeah, it was like 12 years ago. You were 7. Right, there you go. Right. So the clock resets to 7. You got you. You probably get to 1 by the time it's 7, 8. Right. As I stated, we are going to discuss liabilities in the next 2 chapters. Chapter 9 is about current liabilities. Current liabilities, you have to pay these within 1 year or the company's operating cycle, whichever is longer. Right? This is current liability. Next chapter, we're going to talk about long-term liabilities. Long-term liabilities are not expected to be paid within 1 year or the company's operating cycle, whichever is longer. So if it's longer than a year, it's a long-term liability. Shorter than a year is current liability. Internationally, you call it current and non-current.
Would long-term technically also be like part of your future earnings, like knowing that eventually you have to pay them off?
Anytime you take out a loan, then you're dedicating future earnings. It doesn't matter if it's current or long. Now, you might, and this question comes up quite frequently, so I'll answer this one. You might have a liability that's both current and long term. Let's say you have a car with a 5-year note. The current year will be a current liability, and then years 2 to 5 will be long term. Everybody with me? Okay. Uncertainty and liabilities. This is kind of an interesting part because a lot of people, it's kind of hard to believe, but I'm telling you it's true. Sometimes companies lose sight of certain things. They lose sight of who to pay, when to pay their bill, and how much they pay. They lose sight, or uncertainty is created on who to pay, when to pay, and how much to pay their bill. Let's start here. Some of you might be like, how in the world does a company not know who to pay? I mean, it pretty much sounds ridiculous, right? It's like you going to your parents and saying, hey, who do we pay the electric bill to? And they're like, nah, you know, a company. We just send a check. You know that? It sound logical. So let's start. When do companies pay their bills?
When it's most profitable.
When it's most profitable. There we go. All right, when it's most profitable. And how much do they pay? How much do they pay?
The least amount.
No. When they pay is when they pay is when it's most profitable. How much would they pay? Whatever is most profitable. They're gonna pay the amount that's most profitable. Everybody with me? Why would you pay a bill which has a 1% late fee and the company's not gonna stop services when that same money is getting 5 and 10% interest in a bank account? Why would you pay them? You just forego the time limit and then pay the 1% fee and pocket the other 9% that you're still garnishing off the money. Everybody understand that concept? Companies are actively managing their assets, which also includes their money. So money is just not sitting there. Money should be always working for them, doing something to bring back return into the company. So, uncertainty on who to pay is a little bit less complicated than the other two. Well, I guess they're all not that complicated. So who to pay? Sometimes you have a loan, let's say a home loan, and that loan gets repackaged and sold to someone else. Does anybody have any experience with mortgages? Well, when you do, this is just a future statement. Your home loan, there's a chance, will be sold to another company. So the company that you initially get your home mortgage with might not be the company that you end up having to pay on. Everybody with me? Throughout the 30 years or 15, 30 years of your mortgage. So for example, you might take a mortgage with Bank of America. Bank of America might repackage it and sell it to Wells Fargo, who might take that loan and repackage it and sell it to Goldman Sachs, who might take the loan and repackage it and sell it to, let's say, Lehman Brothers. Lehman Brothers goes bankrupt. What happens? So when a company sells your loan, they are no longer the loan holder. They are the servicer of the loan. Meaning you still pay them, and they take your payment, and they pay the person that they sold the loan to. Everyone with me so far? So now, if Lehman goes bankrupt, there's no place for Goldman Sachs to send the money. So Goldman Sachs will send the money back to Wells Fargo. Wells Fargo will send the money back to Bank of America. Bank of America will send the money back to you, and then you will say, well, who do I pay? I didn't even know Lehman Brothers owned my loan. And they will say to you, well, you need to call what's called the thrift, or the FDIC, in order, the thrift, and ask them who to pay. Everybody with me? This was a big issue during the mortgage crisis. These mortgage companies would go under, and then, that people were informed, hey, the person that was holding your loan is no longer holding your loan, and you need to figure out who owns your loan. Everybody with me? So due to that process, that is one way that you can create uncertainty on who to pay. On the other side, we have uncertainty on when to pay. When to pay and how much to pay are highly correlated. Just like we said a second ago, most companies pay when it's most profitable, and the amount is most profitable. So they pretty much have dictated prior to payment when they're gonna pay and how much they're gonna pay. A lot of companies could care very less on the bill that they receive. They have their own, especially the larger corporations, they'll have a department of accounting that does cash management. If not the CFO and the controller doing it. And those individuals will dictate, hey, this is when we'll send out payments. Everyone with me? So with that being said, sometimes they'll just set up payments. They'll say, we'll pay on this date, and they, with bill pay now, with online billing, they just set that up and they just send it. When that occurs, if they haven't already stopped mail-in invoices, sometimes they'll just stop those. They'll get them electronically to just an email. That makes sense? And if they do that over a long period of time, guess what'll happen? They'll lose track of who to pay. They'll lose track of when to pay and how much to pay. And how do they find out that information? One day someone comes in an account and says, hey, why are we still paying X $200 a month? Everybody understand that? So it's the concept of profitability that sometimes gets people off track on when to pay and how much to pay. So let's talk about known liabilities. These are things that we know normally when we put them on the books, right? So we know accounts payable. Accounts payable is the liability that we've dealt with the most throughout this course, right? It's just a short-term liability when people loan us money for a good or a service. Sales tax and liability, sales taxes payable, we'll talk about that in a second. Unearned revenue, we'll discuss that. Unearned revenue is when we receive money, but we haven't given them the product or performed the service yet. So we have unearned revenue. Short-term notes payable is a note. Payroll liabilities, we'll talk about that in a second. And multi-period known liabilities. These are all of our known liabilities that are on the books. Sales taxes payable. Sales taxes are still the responsibility of the company to collect. Sales taxes are still the responsibility of the company to collect. So with Max Hardware store, building materials, sell building materials $7,500. That is subject to a 6% tax. You take the $7,500, times it by 6%, you get $450. That's the amount that the company needs to hold back for taxes. So we will debit the cash, $7,950, credit the sales, and credit the sales taxes payable. And that will be a short-term liability account. Normally sales taxes are either paid monthly or quarterly. Unearned revenue, we've discussed this also, but we'll do it again. Let's say A1 Catering received $3,000 in advance for catering a wedding party to take place on July 23rd. When they schedule it, they have to pay in advance, so we're gonna debit the cash, credit unearned revenue for the catering company. Catering company received the cash, but they haven't provided the service. When they do provide the service, we're gonna debit the unearned revenue and credit the cash for the amount that they, amount of services they provided. A note given to extend a credit period. So sometimes individuals, this is not, sometimes individuals give a note to extend an accounts payable credit. So here Matrix asks Carter Company to accept a 90-day 12% note to replace its existing $5,000 accounts payable. Right? Carter accepted. So when they did, we're going to debit the accounts payable. We're going to take that off the books. So we no longer have an accounts payable. What we have is a notes payable. So we're going to credit notes payable. Then on October 30th, Matrix pays the note plus the interest. We're going to pay the interest, how we're doing the calculation with the interest, it's called the PERT, principal, rate, and time. So the principal in this case was $5,000. The rate was 12%. And the time, we had it for 90 days out of 360 days. Now, a couple of you might be saying, well, why isn't this 365 days? This is called banker's interest. So they take 5 days out. There's a crude accounting joke about that those 5 days are for Goldman Sachs, JP Morgan, Lehman, but nobody's laughing, so I'll stop that joke. But that joke is good money at an accounting function. You guys are cool, so So the interest, you multiply all these together and you get $150. That's your interest payment. So we're going to debit interest expense, debit the note, because we're going to pay the note, and we're going to credit the cash for $5,150. That's the amount we're going to pay. Questions so far? Okay, good. This is a promissory note. You guys, especially throughout college, if you take out a loan, you'll sign a promissory note, but you probably, these are done electronically now, so you might not realize that you're signing them as much as they're not as noticeable as they used to be in the past. That's the best way I would sum that up. Face value equals amount borrowed. So here, this promissory note is September 1st. Jackson Smith borrows $20,000 from American Bank. The note bears interest at 6% per year. The principal interest is due 90 days. So when they do that, they're borrowing cash, so they'll receive $20,000 cash. So we'll debit the cash, credit the notes payable. When they pay it back in 90 days, we're gonna do the PERT. Principal is $20,000. The rate is 6%. The time is the 90 divided by 360. And we'll multiply that out, you get $300 of interest expense. So we will debit interest expense, $300. Debit notes payable, $300. Credit cash, $20,300. What happens if the end of the period comes between the note date and the maturity date? We've dealt with that before, past instance, right? So here James Burrow makes would make the following entry. They have a note, so they debit the cash, credit their notes payable. On December 3rd, because the note was made on December 16th, on December 31st, they want I want to make sure that interest is in its correct period. So it's going to be in the, well, let's say the 2018 period. So we'll take 8,000, which is the principal. The rate is 12%, 15 days over 316, get $40. Debit interest expense $40, credit interest payable $40. And then in February, when we pay the note, what we're going to do is debit the notes payable $8,000. We're going to also debit that $40 interest payable, because now we're going to pay that as well as the interest expense that we incurred for the current year, 2019. And we'll credit the cash for the total amount, $8,160. Yes. Questions on that series of transactions? Payroll liabilities. Employees have amounts withheld from their paychecks based on their earnings, and employers also incur expenses and liabilities for having those employees, right? A lot of people, they take their check, and what they see on their check, they basically think, oh, that's what I made. Not exactly, right? There's your gross pay, and then there are all these things that have to be taken out of your check, and then what comes after is just your net, or what you take home, right? And so, let's go over some of these. Let's go over these things that are being taken out of your check. First and foremost is FICA, Federal Insurance Contributions Act, right? They take out Medicare, they take out for Medicare, and they take out for Social Security, right? Now, they take 6.2% of the first, I believe this number has gone up, I think it's close to 120,000 now, but when this slide was made, it's 110,100, right? And so there's a max. So when you're doing your homework, make sure you keep an eye out that people are exceeding their FICA Social Security max. If they are, they need you need to know that once they get over this ceiling, they don't owe any more Social Security. Everybody with me? This microphone working? Everybody with me? Hello? Hello? All right. Yeah. Just make sure. Now, Medicare has no ceiling. So it's 1.45% of all of your earnings. It doesn't matter if the person makes $1 million or a penny. 1.45%. And the employers withhold this amount. So this will be on the employer's books. Also, they have to withhold federal income tax and state and local income tax. That's what the employers have to do. Employees can also, there are certain things called voluntary deductions. Employees can take voluntary deductions, right? They can have union dues taken out of their account, savings accounts, pensions, insurance, or money to charity. All that money can be taken out of their account. Out of their paycheck. Out of their paycheck. And that, an employee's journal entry might look like this. Right, your salary expense is $4,000. Then you take out their Social Security, Medicare, federal income tax, medical insurance, union dues, and this accrued salaries payable is what they receive back. Why did we put it as a credit to salaries payable instead of a credit to cash? thinking caps.
What was it?
Why did they make this a credit to salaries payable instead of a credit to cash? Start calling names.
Because they're not gonna pay it till it's most profitable.
They're not gonna pay it at this moment. Why are they not paying it?
Maybe they pay bi-weekly.
Right. Kamal's right. He says means of pay is bi-weekly. Companies normally don't pay on the same day that they stop the weekends. That makes sense? So you might get paid for work that you did the 1st through the 15th of a month on the 31st. Everybody with me? So this entry is to close out that pay period. But that pay period might not be paid until either the following week or the following 2 weeks. Does everyone understand that? So therefore, when you're doing the transaction, the initial one, with these payables, salaries, accrued salaries will be a payable. Then when you pay it, it'll be a debit to salaries payable and a credit to cash. Everyone with me? You with me? If you're with me, say yes.
Yes.
If you're not, let me know if you have any questions. Chugging along. All right, so on the employer's taxes side, employers have to pay an equal amount of tax that the employee has to pay for the Social Security and Medicare. So this employee paid, if you go back a slide, this employee paid $306 for Social Security and Medicare, so does the employer has to pay the same amount. See here. They also have to pay unemployment tax. How unemployment tax works? Federal unemployment tax, 6.2% of the first $7,000 of wages have to be paid, have to be taken out of each employee's check. However, the federal government gives this discount, a credit of up to 5.4% for state unemployment taxes. And since they give a credit for all states up to 5.4%, how much do most states charge for their state unemployment tax? 5.4%. Exact amount of the credit. Except for some of these more progressive states. I don't know if I like to call them progressive or not, because it gives them a progression sounds. Progressive has a tone of I don't know, goodness, like you're going somewhere positive. And sometimes I hear it and I'm like, not so good. So here's the entry for the employer. See, remember Social Security is $248, and Medicare is $58. So this would be their journal. And multi-period known liabilities, right? Unearned revenues from magazine subscriptions are often covered in the accounting period, right? Notes payable, these are just some of the things. Well, notes payable will often extend over more than one accounting period. So a 3-year note payable would be classified as both current and long-term. That's something I mentioned at the beginning of class, that you have a liability that's both current and long-term. Estimated liabilities. Estimated liabilities is a liability is a known obligation of a certain amount, but one that could be reasonably reasonably estimated, right? So stuff like health benefits, right? Let's assume that employer agrees to pay an amount on medical insurance of $8,000. And contribute 10% to the employees, of the employee's $120,000 gross salary to retire. So what's gonna happen is we're gonna expense those benefits off of our account in the beginning of the year. It's in the first month. Okay. Vacation liabilities. Assume an employee earns $62,400 a year for 2 weeks of paid vacation. There's a calculation that we'll do for that. I wish the computer would show you. The slides seem to have been stuck. So what they'll do is they'll calculate the $62,400. There we go. That's bonuses. There we go. I'll show you this. Divided by 50 weeks, and you'll get $1,248. Then they'll divide it by 52 weeks, which is a normal year, and you get $1,200. You subtract these and you get $48. And then we're going to debit vacation benefits expense, $48, and credit benefits payable. This is a point where normally I go by. Do you guys know why you get vacation?
For school?
No. It's from why your employer gives you. Hmm?
So like a labor law?
Huh?
Like a labor law?
Yeah, it's a law. It's not really a law. It's not quite a law because everybody has different vacation. Why do they do it? Come on, folks.
You work a
Like
certain,
retain employees?
you work a certain amount of hours.
What's the simple answer?
So they don't have to pay you?
What's the simple answer? Why do companies give vacation? What's the simple answer?
Because they can't pay you.
You get paid for vacation.
Because you work a certain amount of hours.
You get paid for vacation, huh? What'd you say?
Because you work a certain amount of hours.
It's most profitable, everybody. That's the simple answer. No. Everything,
When in doubt,
remember,
it's most profitable.
every action that a company makes is profitable. It has to be profitable.
How's that most profitable?
Great question. So, two things. One is because we scientifically know that humans need so much of a break. I mean, we've academically tested this, whether it be your 5-day work week or your 8-hour shifts. That makes sense? This is optimization of the workforce. Yeah, that's optimization of the workforce. I will go into that a little bit deeper, but there's certain concepts that I want to throw up on YouTube because it takes a second to digest optimization of the workforce. Does that make sense? But the other thing is that especially when they ask for you to take at least 1 week contiguous, like joint, back-to-back days, they're actually looking for fraud. Because if you're committing a fraud in the business, if you're gone for a week, that fraud tends to start manifesting itself, especially if you're gone 2 weeks. That makes sense?
In what way?
Because when you're gone, other people have to take up your slack.
Right.
And if you remember a couple of, I believe we talked about this in chapter 4, about the fraud triangle. So what's the one thing we're trying to get you to do with all of these internal controls we have is for you to collude. I know collusion is all in the news now. Collusion is something that law enforcement and I'm not saying we're trying to get you collude, meaning we're pushing you towards committing a crime. We're saying that if you do commit a crime, we're trying to make sure that one person by themselves can commit a robbery or can commit a fraud. Everybody with me? That you're gonna need more than one person. And when you need more than one person, that means that there's a chance that it will break down because one or two of the other individuals will reveal what's going on. I'll give you, for example, there was a lady at a facility, and what she was doing, she was taking like extra meat, and like there would be a meat delivery. Let's say they delivered like 20 pounds, she would put it down as 18 pounds and keep 2 pounds for herself. That makes sense? So it's just kind of sliding the adjusting the scale. And how she got found out was when she went on vacation, now the meat delivery had to be taken from somebody else. And the guy was like, so you still wanted to be 18 pounds, right? And the person was like, no, you gave me 20 pounds, I need to put it down as 20 pounds. And he was like, oh, I thought we always did 18. That's how the fraud started to be revealed. Everybody with me? So, that, being on vacation is not just for altruistic reasons of happiness of employees, but there's also a business profile underneath that. Bonuses, how we calculate bonus, there's an algebraic equation here. So we'll take the bonus equal whatever the percentage is times your gross minus the bonus, or the amount that we calculate for the bonus. And then we do some calculations here to come up with the bonus. Since, because we have two unknowns on two sides of the equation. Warranty. If you have a warranty, you need to estimate the expense, and then so there'll be an estimated warranty liability expense that you'll take to the side. It will work the same way the bad debt expense. Remember we had allowance for doubtful accounts. So when someone comes and uses their warranty, we'll take it out of the estimated warranty liability. We won't take it out of cash or we won't have an additional expense for that. Contingent liabilities is the last piece of this puzzle for current liability. Contingent liabilities are liabilities that are contingent upon something. Okay? And so we have a matrix for this. This matrix, when I was studying for the CPA, I saw this matrix. So this is the real matrix for this. So with contingent liabilities, the first thing we do, we estimate is something remote, possible, or probable. Everyone with me so far? So let's say, for example, what is the chances that there will be a hurricane in, let's say, Billings, Montana, right? There'll be a what's the chances there'll be a hurricane in Billings? Thanks, Jesse, for giving him a sign.
I was like shaking my head like that.
Yeah, right. Wait. So what's the chances there'll be a hurricane in Billings, Montana? Is it probable, possible, or remote? Remote. So if anything is remote, right, if there's a liability that's remote, you don't have to disclose it. Everybody with me so far? So how about, what's the chances that there will be a hurricane to hit Richmond, Virginia? So it's possible, right? It's not probable, but it's not remote. That makes sense? So it's possible. And to that fact, you just need to put it in the notes that this thing can happen. And then the last question is, what's the chances that a hurricane would hit Miami, Florida?
Probably.
Yeah, right. They're pretty much in the bullseye. So it's probable. So then the next question you need to ask yourself is, can you estimate the liability or not? Normally, companies are gonna say what? This is an easy question. They're gonna say, no. Normally, the company's gonna say what?
Whatever's most profitable.
Incidents most profitable. There we go. There we go. See, they're going to say give the answer that's most profitable, and normally that is no. Because if you say no, then you just have to say on the note in the books, in the notes, hey, there's a probable chance we'll have a hurricane. You don't have to disclose. However, if you say, yeah, we're probably gonna have $1 million worth of damage, guess what? You gotta record that in your books and debit your expense and credit your liability, which will hit your books. So you don't want that to happen, so therefore, you're normally gonna say no. Here's your ratio. And that's the end of this chapter. It's pretty easy chapter.